Good afternoon and welcome to Bulls, Bears, and the Bell. We're your shortcut, really, to understanding what actually went down in the U.S. equity market today, September 23rd, 2025. Not just, the headline noise, because if you only looked at the closing bell today, well, you'd be tempted to call it a massive win for the Bulls, wouldn't you? I mean, the big indices, the S&P 500, the Nasdaq Composite, even the Dow, they all finished in the green. Nasdaq and S&P hitting fresh records. Looks like pure euphoria, right? Especially with that huge AI news. But that clean finish, honestly, it's a bit of a facade. So our mission here in this deep dive is to take the market intelligence report we've got and try to square that headline performance with the pretty deep anxiety and caution that was really bubbling just beneath the surface. This was definitely not a case of a rising tide lifting all boats. Not at all. The sources are crystal clear. Today was a classic tale of two markets. Let's kick off with that closing snapshot. The numbers themselves kind of give the game away about how narrow this rally really was. So the S&P 500, it closed up a respectable 0.44%. The tech-heavy Nasdaq Composite, that led the pack, gaining 0.70% strong. And the Dow, it was the laggard of the majors, up just 0.14%. But here's the kicker, the data point that really tells you where the conviction wasn't flowing. The small cap Russell 2000 index. It's,
Yeah.
often seen as the bellwether for domestic economic health, risk appetite. It closed down 0.15%.
Yeah, and that's huge. That small cap underperformance, it just highlights this extreme, almost laser-focused preference in the market right now. It's all about those giant, seemingly insulated mega cap tech names, not the broader, more economically sensitive stocks you'd want to see participating in a truly healthy bull run.
Right. So this deep divide, the schism, you could call it, it wasn't just random market noise today, was it?
Not at all. It was the direct result of two um, massive, almost tectonic forces pulling the market in completely opposite directions all day long. You could almost feel the tension, even if the main indices looked, calm on the surface.
Okay, so what were these two forces?
We can pin them down pretty
Yeah.
clearly. On one side, you've got Force One, the euphoria. This is the big secular growth story. It stems directly from the AI catalyst. And today, that catalyst produced what we're calling the NVIDIA shockwave. Big money flowing into a long-term story.
AI euphoria. Force one.
And then, on the other side, driving all that caution and the weakness in small caps, you have Force 2. The anxiety. This is the macro catalyst. We're calling it the Powell ponderance. That constant background hum of fear, right? Stemming from monetary policy worries, rising volatility, those recession signals flashing in the bond market. The whole day was just this powerful, real-time battle. Unstoppable growth narrative versus this immovable object of cyclical fear.
Okay, let's unpack the unstoppable force first then. That AI news was genuinely massive, wasn't it? Seems like huge validation for the whole tech bull thesis. The sources detail this landmark partnership. It really feels like confirmation that the AI revolution isn't just talk, it's accelerating with real money, serious money.
Yeah, absolutely. We're talking NVIDIA, the clear leader in AI hardware, the chips planning to invest up to, get this, $100 billion in OpenAI, the pioneer in generative AI.
100 billion? Wow.
Yeah. And that capital, it's specifically earmarked to build out next-generation globally distributed AI-powered data center infrastructure. Just think about the scale of that. $100 billion focused on building the future nervous system of AI.
Why so much, though? Is $100 billion just a headline number, or is it truly necessary?
Oh, it's necessary. That figure is astonishing, yes, but it's also a competitive statement. It signals we've moved past the R&D tinkering phase and firmly into the execution phase of the AI capital expenditure, or CapEx cycle. The scale is driven by the sheer cost of these next-gen AI accelerators, NVIDIA's own chips, ironically, plus the massive energy footprint and the physical infrastructure needed to house and power all of it. It's unbelievably expensive.
So this alliance, the chip maker and the AI leader, what's the signal to the wider market?
It's an unequivocal signal. It validates the, frankly, eye-watering valuation premiums on these mega-cap tech names. It says the AI CapEx cycle isn't just alive and kicking, it's accelerating, maybe exponentially. And that means a huge, multi-year tailwind for the entire semiconductor ecosystem, obviously, but also cloud giants, anyone in that AI supply chain. It's like the secular growth engine just got a massive nitro boost.
A nitro boost, okay. But that boost clearly didn't create a broad rally. Why not? As money poured into AI, something else was pouring in too, right? Fear.
Exactly. That brings us to the tempering force, the macro catalyst. While the NVIDIA news gives you this fundamental multi-year reason to be bullish on tech, the market just cannot escape the immediate gravitational pull of monetary policy concerns. This is that underlying anxiety that just stops Truly unbridled optimism from taking hold across the entire market.
And it comes right after the Fed's first rate cut of 2025, which was just last week. So investors are probably hypersensitive right now.
Hypersensitive is the word. They're scrutinizing every syllable from Fed officials, desperately trying to figure out, was that first cut the beginning of a nice, managed easing cycle, the famous pivot, or was it just, an emergency insurance cut because the Fed sees a deeper slowdown coming that they're trying to get ahead of? Big difference.
And the main man himself, Fed Chair Jerome Powell, he didn't exactly soothe nerves this week, did he? Those comments about valuations.
No, he definitely injected a dose of caution. His recent remarks describing equity valuations specifically as fairly highly valued, well, that's not something you easily dismiss when indices are literally sitting at all-time highs.
Fairly highly valued. That sounds deliberately cautious.
Oh, absolutely deliberate. When the head of the most powerful central bank says assets are fairly highly valued, it's a warning shot, fired strategically. It's Powell's way of saying, look, our job fighting inflation isn't done, risks are still out there, and don't just assume we're going to backstop every little bit of market froth. That caution acts like a governor, ensuring that every time the market tries to run free on something like the AI news, the big institutional players kind of hold back a bit, forcing that split, that schism we saw with the Russell 2000 lagging.
So the synthesis is the trading day. Secular AI growth battling cyclical Fed and economic fears. The indices won on points, you could say, thanks to a few giant companies. But if you really want to gauge the market's underlying health, you got to ignore those headline index numbers and look deeper.
Precisely. Which brings us to the really revealing stuff in the report, the market internals. This is where we peel back the facade and start decoding the warning signals about conviction, about participation. We're talking breadth and momentum.
Okay, let's start with market breadth analysis. How many stocks were actually going up versus down?
Right. A truly healthy rally, a sustainable one, needs to be broad. You want to see the vast majority of stocks participating, lifting together. Today, the rally was decidedly narrow. Now, advancing issues did technically outpace declining issues on the Nasdaq, for instance. The report shows a modest 1.38 to 1 advanced decline ratio.
1.38 to 1 sounds okay, no.
It sounds okay, but it's modest, and it suggests a rally built on a narrow foundation. Practically speaking, that means the gains you saw in the Nasdaq index. They were mostly driven by big price jumps in just a handful of those mega-cap tech stocks. Most other stocks, they either barely moved or, especially in the small-cap space, they actually went down. This concentration makes the whole market structure pretty vulnerable if those few leaders suddenly falter.
Okay, narrow foundation. But what about volume? The report flags total trading volume at 18.65 billion shares. That's noticeably higher than the 20-day average of 17.5 billion. Doesn't high volume mean high conviction?
It usually does, yes. High volume implies conviction. But here's where it gets nuanced. When you combine high conviction, that high volume, with narrow participation, that weak breadth, the signal changes. It means the conviction is incredibly high, absolutely. But it's focused almost entirely on those few specific names riding the AI wave. It's not a broad market-wide embrace of risk-taking. It's more like a focused institutional bet on one specific technological future while nervousness prevails elsewhere.
Concentrated conviction. Interesting.
But to give the other side, we should do a quick momentum check. Because if you look at the number of stocks hitting new 52-week highs versus new lows, the underlying uptrend, longer term, still looks pretty healthy. That's important.
Okay, what are those numbers?
On the NYSE, the report shows 559 stocks hitting new 52-week highs compared to only 99 hitting new lows. That's a strong positive differential. And the Nasdaq was similar, 234 new highs versus just 42 new lows. So this robust skew towards highs confirms that even though the daily rally was narrow, the stocks that are leading are continuing to push higher over a longer time frame. That keeps the market from falling into, really dangerous technical territory. The overall path is still up, just the ride's getting bumpier.
Speaking of bumpy, let's talk about what might be the most startling data point of the entire day. If the narrow breadth was a yellow flag, this VIX divergence feels more like a flashing red siren. This really highlights that institutional anxiety we talked about.
This is absolutely the critical piece that underlines the whole tale of two markets. We're talking about the CDOE Volatility Index, the VIX, often called the fear gauge, right?
Yeah.
It measures the market's expectation of volatility over the next 30 days.
And normally VIX goes down when stocks go up.
Exactly. Normally, VIX and the S&P 500 have a strong inverse correlation. Stocks rise, fear recedes, VIX falls. Simple. Today, That relationship completely shattered. The S&P 500 gained a respectable 0.44%, a solid up day. But the VIX, it surged 4.21% to close at 16.10.
Up VIX on an up S&P day, okay?
That is the classic textbook definition of a bearish divergence. It's a direct conflict between the price action you see on the surface and the underlying risk sentiment simmering beneath.
Help us unpack the mechanics there a bit more. Why the VIX specifically? What does this tell us about what this so-called smart money, the big institutions, were actually doing today?
Okay, this is where it gets really insightful. That VIX spike tells us that professional institutional traders, the folks managing billions, were actively and maybe even aggressively buying portfolio insurance.
Portfolio insurance, meaning
Meaning they were systematically buying short-term put options, primarily on the S&P 500 index. A put option gives you the right, but not the obligation, to sell at a predetermined price. So they're essentially paying a premium, and because the VIX spiked, they were paying a higher premium for the right to sell their holdings at a guaranteed price if the market suddenly tanks in the next 30 days.
so they're paying for downside protection even while the market's going up?
Precisely. It costs them money today, reducing their net gains, but they're willing to pay it. It's like they're saying, okay, yeah, we'll ride this AI wave for now, enjoy the record highs, but we fundamentally do not trust the stability here. Maybe it's upcoming Fed speak, maybe economic data, maybe just the altitude. They are actively preparing for more turbulence. That's why the VIX, the literal price of fear, is surging, even as the headline index gains ground. It's a very clear signal that the risk management desks are worried, regardless of the optimism shown by the folks buying NVIDIA.
Wow. Okay, that VIX action really sets the mood for the whole day then. Institutions hedging actively. Let's trace where that anxiety and the capital rotation actually showed up. Analyzing the S&P 500 sector breakdown should tell that story clearly, where money moved into and where it moved out of. The top-performing sectors look pretty defensive, don't they? It seems like a move towards stuff that hedges inflation or benefits from potential rate cuts if the economy weakens.
Exactly right. Number one performer today was energy, the XLE sector fund. It surged a strong 1.91%.
Why energy so strong?
Well, partly propelled by crude oil prices, there's still supply constraints, geopolitical tensions bubbling away. But fundamentally, energy often acts as a hedge against inflation, and the specific strength noted in oilfield services companies think Halliburton, Baker Hughes, suggests investors might be anticipating sustained capital spending in the sector, perhaps seeing value and inflation protection there. It's a classic rotation.
And number two was real estate. That feels like a rates play.
Definitely a rates play. The XRE fund was up 0.58%. Real estate is highly sensitive to interest rates. Seeing it outperform like this is a strong signal that traders are positioning for the Fed to keep cutting rates, maybe more aggressively than previously thought. Lower long-term rates help REITs, real estate investment trusts, in two ways. Cheaper borrowing costs and, crucially, their dividend yields become much more attractive compared to falling bond yields. So the rotation here is partly a bet on lower rates, likely driven by fears of economic weakness.
And then we had that wild one-off Paramount Skydance, PSKY, that just rocketed on pure M&A speculation, totally separate from the macro. Right?
It completely company-specific. It surged because of reports that a well-known former antitrust official, Makan Delrahim, might be joining their legal team.
And the market reads that as?
The market immediately jumped to. Why hire a big-gun antitrust lawyer unless you're gearing up for a major acquisition fight? The speculation is all around a potential very complex bid for Warner Bros. Discovery, WBD. Just a reminder that sometimes stock moves are just about corporate strategy, not the big picture.
Okay, so energy and real estate up, driven by inflation and rate cut bets. Now, the flip side, where was the pain? Which sectors showed the profit-taking and anxiety most clearly?
Right. This reveals the other side of the coin. Economic worries and maybe just sectors that had run too far too fast.
Yeah.
The day's worst performer, and really the clearest signal of consumer stress, was consumer discretionary. That's the XLY sector fund. It was down a pretty steep 1.38%.
Ouch. Discretionary includes things like cars, retail, stuff people cut back on first.
Exactly. It's the most direct canary in the coal mine for consumer health. And the weakness today was pinned directly on a really disappointing earnings report from AutoZone, AEZO.
Auto parts, what happened there?
They missed their earnings per share estimates, reported $48.71, when the street was looking for close to $50.86. Now, a miss like that from AutoZone, a company that usually does okay when people fix old cars instead of buying new ones, it rings alarm bells.
What kind of alarm bells?
Two main ones. First, maybe the average consumer is so squeezed they're delaying even essential car repairs now. Second, maybe rising costs are hitting profit margins even for relatively resilient companies. That AZO report just cast a pall over the whole sector, fueling those recession worries.
Okay, consumer weak. And the second worst performer, this brings us right back to the core tension, doesn't it? Information technology, XLK, down 1.25%. How does that even happen? NASDAQ hits a record, supposedly fueled by AI, but the actual tech sector, which holds all the AI leaders, is one of the biggest losers on the day.
It's the perfect example of that classic market behavior. Sell the news.
Ugh.
Think about it. The NVIDIA OpenAI deal. That was the ultimate confirmation event. It proved the thesis. So for investors who'd ridden that massive wave up over the past months, seeing record highs and seeing the VIX spike simultaneously, it was the perfect trigger to say, okay, time to lock in some of these huge profits.
On the day of the big news.
Especially on the day of the big news. Institutional money rotated out, taking profits. And here's the key detail. NVIDIA itself, NVDA, after popping higher in pre-market trading on the announcement, actually reversed course during the main session and closed down on the day. That really illustrates the dynamic. Even in the most fundamentally exciting area, the sector was just so technically overbought maybe that investors couldn't ignore the chance to take money off the table, especially with all that macro uncertainty swirling around.
So, rock-solid belief in the long-term AI story, but massive anxiety about the short-term macro picture, pushing money into defensive plays and out of recent winners. It's a complex picture. To really complete it, we need to look beyond stocks, right? To bonds, commodities, the dollar.
Absolutely. The cross-asset view is crucial here. And the treasury market, the bond market, is sending probably the deepest, most complex, and frankly contradictory signals right now. We really need to dissect the yield curve structure.
Okay, break it down for us. What were the key treasury yields today?
At the close, the benchmark 10-year Treasury yield was sitting at 4.12%. The 2-year yield was lower at 3.59%.
Okay.
Now, the key relationship many watch is the spread between those two, the 10-year minus the 2-year. That spread is positive at 53 basis points or 0.53%. After the Fed cut rates last week, seeing this spread widen is what bond traders call a bull steepener.
Bull steepener sounds positive, but what does it actually signal about economic expectations?
It generally signals market confidence that the Fed can engineer a soft landing. The idea is the market prices in more Fed cuts, pushing short-term rates, like the 2-year, down, while longer-term rates fall less quickly or even stabilize because the long-term growth outlook isn't collapsing. So the curve gets steeper. It's broadly seen as optimistic, suggesting any slowdown will be managed, mild, and met with continued rate cuts.
Okay, so the 10-2 spread looks optimistic, but you said contradictory signals.
Exactly, because we cannot stop there. Another segment of the yield curve, one that historically has been arguably more reliable as a recession predictor, is still screaming a warning. We're talking about the spread between the very short-term 3-month Treasury bill yield, which closed today at 3.94%, and that 2-year note yield, 3.59%. That spread remains inverted. The 3-month yield is higher than the 2-year yield.
And that specific 3-month versus 2-year inversion, that's the big recession flag, isn't it? Why does that part of the curve carry so much weight, even if the 10-2 looks okay?
It carries weight because it reflects immediate near-term lending sentiment among the biggest players. An inversion there means it costs more to borrow money for just 3 months than it does for 2 years. Think about that. Your bank is effectively charging you a higher interest rate for a 90-day loan than for a 730-day loan.
That sounds backwards. Why would they do that?
Because they're deeply nervous about the immediate future. They might fear a sudden liquidity crunch, or maybe they worry the Fed will be forced into surprise hikes short-term if inflation flares up again, or they just see the economy hitting a wall very soon, leading to credit problems. So bond investors are effectively saying two things at once. Yes, the Fed will probably cut rates more over the next couple of years, hence the bull steepener, but they'll be cutting because the economy is heading into real trouble very soon, hence the 3-mid or 2Y inversion, not just gliding into a soft landing. That specific inversion is the bond market's loudest alarm bell right now.
That juxtaposition is incredible. It's the perfect parallel to the stock market action, isn't it? Long-term optimism AI, the 10-2 steepener versus immediate present fear, the VIX spike, the 3-mid or 2Y inversion. Okay, what about the US dollar, the DXY index?
The dollar index, which measures the dollar against a basket of other major currencies, it continued its recent slide, closed slightly down today, around 97.267. This weaker dollar is generally seen as a positive tailwind for U.S. corporate profits.
How so?
Two main ways. First, for the huge U.S. multinational companies that dominate the S&P 500, a weaker dollar means their overseas earnings translate back into more dollars when they report results. It boosts reported profits, basically. Second, a weaker dollar tends to support global commodity prices because commodities are usually priced in dollars, so they become cheaper for buyers using other currencies. And that brings us nicely to the wild action in gold.
Yeah, gold was incredible today. It almost rivals the VIX spike in terms of reflecting deep anxiety, doesn't it?
Absolute spectacular. Spot gold rallied a full 1.0%, closed at a stunning $3,784.01 per ounce. And get this, it hit a new all-time intraday high during the session at $3,790.82.
Wow. And this isn't just a one-day pop. The report notes year-to-date gains are over 44%. That's enormous for gold. What's the message here? Is it just inflation hedging?
It's way beyond just simple inflation hedging at this point, I think. A rally of this magnitude hitting record highs sends a much deeper message. It reflects profound structural concerns among global investors about, well, several things. First, yes, fears of persistent, maybe even uncontrollable inflation down the road. Second, real worries about the sheer scale and sustainability of global government debt. Are we reaching a point where central banks might be forced to effectively print money to monetize that debt? And third, maybe most crucially, it reflects a growing desire for a reliable safe haven asset that exists outside the traditional financial system, outside of government control. Gold is playing its ancient role as a store of value that big money is suddenly finding very attractive again. Its strength, combined with the VIX spike and that inverted part of the yield curve, it's like a three-pronged warning siren about potential instability that the tech rally is currently ignoring.
A three-pronged siren call. Okay, but contrasting sharply with gold's big move, crude oil was hesitant today. WTI settled slightly down 0.26% at $62.18.
Yeah, that oil price action perfectly reflects the tension in that market. On one side, you still have the supply constraints, the geopolitical risks, the factors that boosted the energy sector, XLE today. But on the other side, you have these mounting worries about a global economic slowdown, potentially crushing future demand for fuel and industrial products. The fact that oil basically treaded water suggests those recession fears are currently strong enough to offset the immediate supply worries. It's a stalemate.
Okay, and finally, in cross assets, what about the most speculative end? Digital assets, Bitcoin.
Now, Bitcoin, BTC was pretty muted, actually. It posted only a modest gain, about 0.74%, trading around $113,085.
What does that tell us?
It's quite telling, I think. Bitcoin is generally seen as a high-beta, risk-on asset. If today was truly about broad-based, unbridled enthusiasm taking over, you'd typically expect Bitcoin to be rocketing higher alongside the Nasdaq's record close. The fact that it couldn't muster a strong rally, especially given this narrative of massive capital flowing into tech futures, suggests that cautious sentiment is still deeply entrenched, even in the most speculative corners of the market. Investors aren't just throwing caution to the wind everywhere. They're being very selective about their risk bets.
And a quick check globally. Was the picture clearer elsewhere?
Not really. Sentiment was just as mixed overseas, mirroring our own internal split. Asian and European markets didn't offer a clear lead. You saw gains in semiconductor-heavy markets like South Korea, obviously benefiting from the AI tailwind. But then key economic hubs like Hong Kong's Hang Seng Index were down 0.7%, suggesting those global trade and economic growth worries are very much alive and well.
Okay, let's pivot back then and zero in on the absolute centerpiece of today's AI euphoria. NVIDIA. Even though the stock itself closed down today due to that profit-taking we discussed, the underlying technical setup sounds incredibly bullish, according to the report.
Yeah, despite the slight pullback today, the technical picture for NVIDIA is compelling. It suggests institutional conviction might be building for the next major leg higher.
The report mentioned the stock broke out of a pattern on Monday, a multi-week symmetrical triangle pattern. Can you unpack that for us? What does that pattern mean, and why is the breakout significant?
Sure. A symmetrical triangle forms when a stock's price bounces between two converging trend lines. One line slopes downwards, acting as resistance overhead, and the other slopes upwards, acting as support underneath. The price gets squeezed tighter and tighter. It often represents a period of consolidation, a pause, where buyers and sellers reach a temporary equilibrium before the dominant prior trend resumes. Since NVIDIA was in a strong uptrend before forming this triangle, the pattern is considered a classical continuation pattern, meaning the expectation is the uptrend will continue.
Okay, so the breakout is the signal the pause is over.
Exactly. When the price decisively broke above that descending resistance line on Monday, it signaled the end of the consolidation and the likely resumption of the bull run. And crucially, the report highlights that this breakout happened on a massive surge in trading volume.
And high volume confirms the move.
Yes, that high volume is critical validation. It tells us the breakout wasn't just noise or a fake out. It had real institutional buying power behind it. It confirms strong support for the next potential push higher.
So today's slight dip closing down, that was actually technically healthy, like a retest of the breakout.
Precisely, you could see it that way.
Hmm.
The stock held firmly above that key breakout level from the triangle. That level now ideally acts as a new support floor, a place where buyers who missed the initial breakout might step in. Traders are now watching key support levels very closely. The primary zone seems to be around $175. That level is significant because the report notes it lines up with both the old triangle trend line and the 50-day moving average, a confluence that often attracts buyers. Below that, deeper support might be found near $165 and then $150.
And based on this triangle pattern, what's the potential upside? The report mentions some pretty aggressive price targets like $207 and maybe even $255. How do analysts get those numbers?
Those targets usually come from a standard technical analysis technique called the measured move calculation. Basically, measure the height of the triangle at its widest point, the base, and then you project that same distance upwards, starting from the breakout point. Applying that here gives a near-term projected target around $207.64. Now, if the broader AI story continues to unfold positively and the stock recaptures the momentum it had before the consolidation, a longer-term projection, often based on the magnitude of the previous uptrend, could potentially target levels like $255. It's essentially technical confirmation backing up the fundamental growth story.
It helps to put that in context for you, the listener. The wealth creation from a stock like NVIDIA is just staggering, and it explains why institutions might cling to that long-term AI thesis despite all the macro static. Think about this. The sources ran a hypothetical. If you had invested just $100 in NVDA 1 year ago, today that $100 would be worth about $157.93. That's nearly a 58% gain in a year.
Impressive.
Now, stretch that back 3 years, covering the real ramp up in AI chip demand. That same $100 investment. Today, it would be worth a mind-blowing $1,467. That's a return of over 1,300%.
Yeah.
That kind of long-term compounded return is the bedrock force driving the NASDAQ, even when fear is palpable elsewhere. Okay, let's shift focus now to the immediate future. We need to point you towards what matters next. This market tension we've dissected, it's going to be tested very quickly by upcoming economic data and some really crucial earnings reports.
Absolutely. Tomorrow's economic calendar zeroes right in on the housing sector, probably the most interest rate sensitive part of the whole economy. All eyes will be on the new residential sales report that's due out at 10:00 a.m. Eastern Time.
Why is that report so critical right now?
It gives us a timely post-check on the health of the U.S. housing market. It'll show how consumer demand for big-ticket items like new homes is really responding to the current rate environment, and especially to that recent Fed rate cut. Any significant weakness there would definitely amplify those recessionary warnings we saw in the yield curve today.
And earnings. Sounds like we have some big ones coming up that could sway sentiment, especially in tech.
Oh yeah, absolutely critical earnings on deck. Tonight, reporting after the closing bell, we get results from Micron Technology, MU.
Micron. Memory chips, right? Why is that one so important?
It's arguably the most critical report for the tech sector in the immediate term. Micron makes DRAM and NAND memory chips essential components in everything from the giant data centers powering AI to PCs to smartphones. So Micron's results, and even more importantly, their forward guidance, what they expect for future demand, act as a vital, direct barometer for the entire tech supply chain. If Micron comes out cautious, if they say they see inventories building or demand slowing, well, that could be an immediate reality check for the AI euphoria and could definitely test that new support level we talked about in NVIDIA.
Okay, Micron tonight is key. What about tomorrow morning?
Before the market opens tomorrow, we get a couple of interesting non-tech reads. First, Cintas, CTAS. They provide corporate uniforms, cleaning services, things like that. They're actually a fantastic proxy for the overall health of the U.S. labor market and general business activity, especially among small and mid-sized businesses. Strong results there could counter some of the consumer weakness fears. And we also hear from KB Home, KBH, one of the major home builders. Their results will give us a direct company-level view of the housing market, which will perfectly complement that government new residential sales data coming out later in the morning.
Okay, so we've covered a lot of ground. The record indices masking narrow breadth, the AI deal versus Fed caution, a VIX spike, gold soaring, the split yield curve, NVDA's technicals. If we synthesize all of this, what's the central, inescapable theme of today's market action?
I think the unavoidable conclusion is that today was just a perfect textbook example of a powerful long-term growth narrative, the AI revolution, supercharged by that huge NVIDIA OpenAI commitment, managing to temporarily overpower very real, very tangible economic concerns. And those concerns, they were visible everywhere if you looked. That historically accurate recession signal flashing in a 3-month, 2-year yield curve, the VIX divergence showing big players actively hedging risk, the flight to safety pushing gold to record highs, the anxiety was palpable.
So the most important takeaway for you, the listener, tuning in to Bulls, Bears, and the Bell, it's really about the sheer cognitive dissonance the market is showing right now, isn't it?
Absolutely.
On one hand, you have this incredible conviction in the distant, profitable future promised by AI. Strong enough conviction to drive major indices to new records powered by just a few key stocks. But at the exact same time, those very same institutional investors are displaying clear present-day fear. They're actively paying up for insurance via the VIX, they're buying safe haven assets like gold, explicitly preparing for a potential near-term economic slowdown.
It's fascinating to watch unfold in real time.
It really is. And it leaves us with a truly provocative final thought for you to chew on. Given that institutional money is simultaneously paying a hefty premium for downside protection while bidding up the valuations of these long-term AI growth stocks, are investors making a kind of unprecedented bet here? Are they effectively wagering that this AI revolution is such a powerful economic force that it can actually withstand or maybe even completely bypass a potential near-term recessionary slump that the bond market and the options market seem to be clearly signaling? That tension right there is likely what's going to define market action for the rest of this quarter.